We are looking at Bitcoin right now trading around the $67,250 mark. And I need everyone watching this to stop for a second and put their emotions aside. I know what you are feeling. You are looking at these green candles on the 4-hour chart. You are seeing the price recover from yesterday's lows of $60,000, and you are feeling relief. You might even be feeling the urge to jump back in, thinking the correction is over and we are heading straight back to new all-time highs. But I am here to tell you, based on the data, the order books, and the macro structure, that this relief rally is likely the most dangerous trap we have seen in 2026. In technical analysis, we have a specific name for what is happening right now. It is called a dead cat bounce. This happens when a market crashes hard, like we saw yesterday, and then bounces mechanically simply because short sellers are taking profits, not because new genuine buyers are stepping in. If you mistake this bounce for a full trend reversal, you are setting yourself up to become exit liquidity for the institutional whales, who are desperately trying to sell their bags at these higher prices before the next leg down begins. Let's dig deep into why this is happening. Yesterday, the market panic was real. We saw a flush down to $60,000 triggered by legitimate fears surrounding the geopolitical negotiations between the US and Iran in Oman. That news hasn't disappeared. The uncertainty hasn't magically vanished overnight just because a few green candles appeared on your screen. The fundamental reason for the drop is still there. So why is the price up? Because markets never move in a straight line. After a violent drop, the RSI gets oversold, leverage gets wiped out, and the price snaps back like a rubber band. Smart money knows this. They expect this. And right now, they're using this pushback up to $67,000 and $68,000 to reopen their short positions. They are selling into your optimism. If you look at the lower time frames, you can see retail traders chasing the green candles, while on the higher time frames, the overall structure is still making lower highs and lower lows. Until we break the major resistance above us, this is nothing more than a bearish retest. I want you to visualize the psychological game being played right now. When Bitcoin dropped to $60,000, everyone was screaming, sell! The fear was extreme. Now that it's back at $67,000, those same people are screaming, buy! This emotional whiplash is exactly how the market makers steal your capital. They needed to push the price up to induce FOMO, fear of missing out. Let's talk about the macro context, because you cannot trade Bitcoin in isolation in 2026. The broader financial world is watching the US dollar index, the DXY. While the dollar isn't skyrocketing to new highs, it is showing incredible resilience and stability. It is refusing to break down. In a risk-on environment where Bitcoin goes to the moon, we usually want to see the dollar collapsing. We aren't seeing that. The dollar is holding its ground because global investors are nervous. They are parking their cash in safe assets, not speculative ones. This creates a liquidity crunch for crypto. If the dollar remains strong, it acts as a ceiling on Bitcoin's price. It suppresses the upside. And then you add the layer of the US-Iran headlines. Even though there are talks in Oman, talks are not a solution. They are an attempt at a solution. The market hates uncertainty. As long as the headline risk exists, the risk that one wrong word could escalate tensions, big hedge funds are not going to go all in on Bitcoin. They are de-risking. They might trade the volatility, but they're not accumulating for the long term right here, right now. Now, I promised to bring you the on-chain data, and this is where the bearish thesis gets confirmed. If this was a true bottom, if $60,000 was the absolute floor, we would expect to see whales moving massive amounts of Bitcoin off exchanges and into cold storage wallets. That is what accumulation looks like. But when we look at the data from Glassnode and other trackers today, we are seeing the opposite. We are seeing net inflows to exchanges like Binance and Coinbase. Whales are moving coins from their private wallets onto the exchange order books. Why would you move 5,000 Bitcoin to an exchange if you plan to hold it for 10 years? You wouldn't. You move it there because you are preparing to sell. You are preparing to dump it into this relief rally. This specific data point is the smoking gun. It tells us that while retail is buying the dip, whales are selling the rip. And in the history of crypto, whenever retail fights against whales, retail loses 99% of the time. Let's look at the liquidation heat map, which gives us the X-ray vision of the market. So what should you do? What is the strategy for this specific scenario? I want to break this down for two types of people, those holding positions and those holding cash. If you bought yesterday near $60,000, listen to me closely. You are in a position of power, but also danger. Do not let greed turn a winning trade into a losing one. This is the time to aggressively take profits. Maybe sell 50% of your position here at $67,000. Lock in that gain. For the remainder, move your stop loss up to your entry point or slightly in profit. Do not hope. Do not pray. Manage the risk. If this is a dead cat bounce, the drop from here will be swift and violent. And you do not want to be the person who rode the elevator up just to ride it all the way back down to the basement. Now, for those of you sitting on USDT or cash, feeling the FOMO, feeling like you missed the boat because you didn't buy the 60K bottom, do not chase this candle. Buying at $67,000 right now is one of the lowest R multiple trades you can take. You're buying right into resistance. Your downside is back to 60K, a 7K weight loss, and your immediate upside is capped at 69K, a 2K gain. Mathematically, this is a terrible trade. The disciplined approach is to wait. You have two options. Either you wait for the price to come back down to $60,000 and see if it holds support again. That's a double bottom, a much safer entry. Or you wait for the price to break above $69,000, confirm it as support, and then buy the breakout. Buying in the middle, in this no man's land between 60K and 69K, is gambling. It is not trading. Be patient. The market will give you a better entry. It always does. We also need to discuss the if-then scenarios because a good trader always has a plan B. What if I'm wrong? What if this isn't a trap? And finally, I want to touch on altcoins because I know many of you are heavy in alts. During a dead cat bounce, altcoins often pump harder than Bitcoin, giving you a false sense of an alt season. You might see some coins up 15% or 20% today. Be extremely careful. When Bitcoin sneezes, altcoins catch a cold. If Bitcoin rejects from $68,000 and drops back to $60,000, those altcoins that are up 20% today will likely drop 30% or 40% tomorrow. Altcoins are high beta assets. They amplify Bitcoin's moves. In a trap scenario, they are the most dangerous assets to hold. If you are in profit on alts, the urgency to book profits is even higher than with Bitcoin. Use this liquidity to get back into stablecoins. Cash is a position. Being in USDT is a valid trade. It allows you to sleep at night while the market decides its direction. To wrap this up, let's summarize the battle plan for the next 48 hours. We are watching the $68,000 resistance zone like a hawk. We are ignoring the emotional relief and focusing on the structural weakness. We are aware of the dead cat bounce scenario, where price rallies to trap late bulls before a continuation of the crash. We are watching the geopolitical headlines from Oman, because one bad update sends us tumbling. And most importantly, we are prioritizing capital preservation over chasing gains. If you survive the crash, you will be there for the real bull run. But if you lose your capital in a bull trap, the game is over. Stay disciplined, trust the data over your emotions, and do not let the market makers use you as their exit liquidity. In my next update, I will cover the 3 specific signals I'm waiting for to confirm the real bottom, so make sure you are ready for that. For now, stay safe, tighten those stops, and keep your eyes on the 68K rejection.